Hi, I'm Roger Montgomery from the Montgomery Fund, and welcome to this week's Video Insight. I'm going to take a step back from domestic economics, and particularly what I think is the very real risk of an imminent collapse in construction jobs, forcing unemployment rates higher and requiring the Reserve Bank of Australia to reduce interest rates, and more importantly, for APRA to facilitate an increasing availability of credit through the banks by lowering the 7.25% stressed mortgage test. Instead, what I want to do is talk about something more pertinent for investors in high beta or high growth stocks. If you have a look at this first chart, you can see for the last 30 or 40 years, interest rates have been declining. And in fact, since 2009, they've hit zero. Consequently, investors have fled from term deposits and cash deposits and looked to invest in other things. One of the recipients of that migration of money out of cash has been private equity. And as you can see in this second chart, you can see a very large amount of money being raised by private equity each year. In fact, it's been growing significantly since 2009. And why is that? Well, people simply didn't want to have their money in cash earning zero, particularly in the United States, or negative rates in Europe, so they handed their money over to private equity funds to go and invest in fast-growing startups. And you can see private equity has put that money to work. Have a look at this third chart. Here you can see the dollar volume in trillions of dollars, by the way, globally, the number of deals that have been done since 2009, which was of course the depths of the GFC. You can see the number of deals has been increasing, and that's obviously a function of the fact that capital raised has been going up. Not only has the number of deals been rising, but if you look at this fourth chart, you can see that competition amongst private equity firms, of which there are many more this year than 10 years ago, competition amongst those firms has resulted in higher multiples being paid for these companies. Now, if you keep in mind that the majority of companies that listed last year and the majority that have listed this calendar year in the United States have been profitless, that is, they're not making a profit, then you wonder just how much more these equity multiples or profit multiples can expand. More importantly, these expanding PE multiples have caused multiples in the stock market to expand as well. Investors who don't qualify for private equity funds because they're not wealthy enough have seen those high equity multiples in private equity land and translated them into the multiples that are being seen on the stock market. But this last chart tells, if you like, fires a warning shot across expectations for further multiple expansion. Take a look at the left-hand side. What you can see in this chart is that investors on the stock market appear to be less willing to pay high multiples for companies that are being sold to them by venture capital and private equity. The step-up multiple is coming down over the last 3 years. What is the step-up multiple? Well, that's the multiple gap, or the difference in the multiple from the final or last equity raise, or the last series when the company was in private equity hands, to either a float or a trade sale. Perhaps because of all the money flowing into private equity, the deals are just getting so big that stock market investors simply don't have the appetite to pay high multiples for those very large deals. Over on the right-hand side, you can see that investors are also receiving a poor return for their investment. In fact, if you bought on the first trade, in other words, you're a retail investor and you didn't have access to pre-IPO access to these companies, what you can see is you're now achieving a negative return if you buy on the first trade when the stock is listed. This could potentially be a negative feedback loop. And lower multiples being paid by equity investors on the stock market may mean that private equity investors are less willing to fund the last rounds of companies' capital requirements at very high multiples. And of course, that starts to unwind the whole boom. We know that booms turn into bubbles and bubbles then turn into busts. And I wonder whether we're on the precipice now. Only time will tell. And we'll certainly keep you in the loop with any of our other insights on this subject. I look forward to talking to you again soon. In the meantime, please follow us on Facebook and Twitter.